Let's calculate the stock price for Planet Fitness. First, we need the market cap, which is 5.9 billion. And now the stock price is 68.12. So the shares outstanding is just the market cap divided by stock price equals shares outstanding. They have 87 million shares. What we're going to do is estimate future free cash flow of the company, then discount that number back to today's dollar amount, and that gives us the intrinsic value of the company. Then we're going to divide that number by 87 million to get the stock price, and we're going to see how it compares to the actual stock price. So let's get started. First, we need free cash flow, and that's in Yahoo Finance in the cash flow section, and then they have free cash flow. And then next we need net income. That's the profit or loss for a given period, and that's on the income statement. And then we need revenue, which is also on the income statement. So it looks like they have steady cash flow, but increasing net income and revenue. So all positive signs so far. Now we need to look at the capital structure of Planet Fitness and figure out the discount rate we need to apply to the future free cash flows. So the interest expense that's on the income statement is 60.9 million. And that's the interest Planet Fitness pays on its debt. Now let's go to the balance sheet to see how much debt they have. 17 million of current debt, and non-current debt is 1.7 billion. So they pay 3.6% interest on the debt. Interest payments are tax deductible, so let's go back to the income statement to see their effective tax rate. So let's get the income before tax. The income tax of 38 million. So they pay 21% of taxes. The cost of debt is 2.8%, and 22% of the capital structure is debt, which is decent. It's not great, but it's not too terrible of a number. You want low debt generally when you invest in a company. Now we need the beta, 1.19, and that gives us the cost of equity, and we get that from the capital asset pricing model. It's 11.5% the cost of equity and 2.8% the cost of debt. And when you combine these numbers together, you get the weighted average cost of capital. And that's the discount rate companies use when they make investment decisions. And that's what we're going to use to discount the future free cash flows. So we estimated 4 years of free cash flows, and then a terminal value, which is all years beyond year 4. Then we discounted those numbers back to today's values, and we get a company value of $3.6 billion. And when we divide the number of shares outstanding, we get a stock price of about $41. And they're trading at $68, so it's trading at a 64% premium. So according to the model, it's a sell. Let's look at historical stock price for this company. And let's see when it was trading at 41. In March it was trading around there, and maybe a year ago as well. So it is trading at a premium. So stocks are just like any other product. It's based on supply and demand. If more people want to buy it, it pushes the price up. If more people want to sell it, it pushes the price down. So this is trading at a premium. So it may be correct. The company may do really well in the future and be able to sustain this stock price. But that's for you to decide. And this is my model, it's my opinion, and thanks for watching.